We know you're all busy and your time is valuable, so thank you for taking time out of your day to attend our webinar. I'm Shannon Stroud, and I'm the Events Manager at Ontario Systems, and I will be your meeting manager today. Just a few housekeeping items before we begin. First, I have some legalese that I need to read so that it's on the record. Please bear with me or read along on the slide that should be showing on your screen. This information is not intended as legal or business advice and may not be used as such. Legal and business advice must be tailored to the specific circumstances of each use. Every effort has been made to assure this information is up to date as of the date of this presentation. It is not intended to be a full and exhaustive explanation of the law in any area, nor may you use the information to replace the advice of your own legal counsel. The presenters, Kaulkin Ginsberg and Ontario Systems, assume no liability for typographical or other errors contained in the presentation and materials, or for changes in the law affecting anything discussed therein. Second, know that we will be sending a link to the recording of this webinar in the next few weeks. I'm sure that question will come up again, and I'll just remind you that yes, we'll be sending a link to the recording in a couple weeks. Know that your phone lines have been muted, so if you have a question, please type it either in the Q&A box or in the chat box and address it to me as the host. This allows us to follow up if we're not able to answer all questions in the time that we have allotted. If you experience any difficulty during the presentation, please send me a chat and I'll address it as quickly as possible. Know that if you experience a delay in the time that it takes for a new slide to load for the presenters, they will continue with their presentation and you can catch up on the visual piece once the system catches up. And that does it for the housekeeping items. To kick things off, I'd like to share a bit about our presenters today. Mike Ginsberg is President and CEO of Kaulkin Ginsberg, providing industry-leading M&A and strategic advisory expertise to the ARM industry for more than 20 years. Clients served include domestic UC and international collection agencies and ARM companies, financial investors, as well as Fortune 500 companies. Mike is a member of the ACA International, DBA, and the Association for Corporate Growth. He sits on the advisory boards of several industry associations and publications. He is a frequent speaker on important industry issues and is often interviewed as an industry expert by the trade, financial, and consumer media. Mike writes a regular blog about the industry and maintains a social media page on InsideArm.com. Mike has been the recipient of numerous industry awards, including the National Association of Retail Collection Attorneys 2009 Don Kramer Award, which recognizes leaders who have made a positive impact on the ARM industry. He has also been recognized by Collection Advisor, a leading trade publication, as one of the industry's most influential professionals for 4 years in a row. Rozanne Andersen is Vice President and Chief Compliance Officer here at Ontario Systems. Over 15 years of experience as General Counsel, Chief Lobbyist, Executive Vice President, and CEO of ACA International, the Association of Credit and Collection Professionals, and 14 years as a practicing attorney, specializing in banking and financial services, have made Rozanne one of the most respected experts in the industry. Her advocacy before both state and federal regulatory bodies and her influence over compliance enhancements integrated in the Ontario Systems product suite help our clients solve their most challenging legal issues, mitigate risk, and navigate an increasingly complex regulatory and legislative environment. Rozanne earned her JD from the William Mitchell College of Law. And with that, I will turn it over to Rozanne.
Thank you, Shannon, and thank you, everyone, for joining us this afternoon. The way Mike and I generally handle these webinars is rather informal. We will accept questions through the chat box. Shannon will help us monitor those questions. Our goal today is to really help you as leaders in the industry and as leaders within your organizations to help you make decisions, business decisions, compliance decisions, and legal decisions. So with that, our first focus is going to be, Shannon, let me just check something here. We would like you to know that we are going to cover latest developments on the regulatory front. We're going to talk about market segment trends that we're observing. merger and acquisition movements and other developments that we think are relevant to you as you make business compliance and legal decisions. Next slide. So the very first topic I think is I'd like to cover this afternoon has to do with just a very brief update on the CFPB rulemaking process. I think most of you on the phone are probably aware that the ANPRM comment period did close in February, and the CFPB has now taken all of the comments filed by private companies, by our leading trade associations, be it ACA International, NARCA, DBA, to name just a few. They have taken those comments under advisement and are now using those comments to create the actual proposed rules. Now, there was a time when we thought that the proposed rules may come out early this fall. As recently as Friday, we've received word from the CFPB that the notice of proposed rules may not come out until the end of 2014. We know that is a goal for the CFPB in terms of releasing the notice of proposed rules, and that will trigger yet another comment period for the industry and consumers alike to respond to the proposed rules. Ultimately, the goal of the CFPB is to have the final rules released in 2015. Just because of the impact the rules will have on the industry and on consumers, even 2015 may be a bit aggressive, but nonetheless, that is the goal of the CFPB. So for those of you who are listening, do not expect final rules to come out anytime soon. There is a very formalized process that the CFPB needs to first follow. But we do want to make you aware of their key areas of focus. Without a doubt, it's debt documentation and verification information. What information do you have available to you, or may you, or do you have your possession of, with regard to documenting the debt for purposes of both verification and collection litigation? They're also very concerned about litigation practices generally. Process serving requirements are at the top of the CFPB's list, so that we should not be surprised if we see rules around collection litigation. Also, call frequency is a big issue for the CFPB with regard to the proposed rules, and also giving consumers the right to express their communication preferences. We are already seeing demands coming from clients to make sure that calls are not only limited to the hours of 8 a.m. to 9 p.m. in the consumer's location. We're also seeing demands coming from clients, supervised entities such as credit card companies and banks and savings and loans, where they are already giving us a heads up that communication preferences by consumers will not only be likely limited by the type and mode of communication, but also the hour preferences that consumers themselves may place on debt collection, meaning just to give you an example, if I am the consumer, I may be given the right to tell the collector or the debt buyer that I choose to only have you collect debt between the hours of 10 a.m. and 2 p.m., for example, in my location. So that potentially could create some very significant challenges for the debt collection community. The CFPB is also very concerned about the collection of out-of-statute debt. It would not surprise any of us to find that a special notice requirement in writing will be required for those people who are collecting out-of-statute debt. And two of the areas, we're going to talk about this in just a second, but two areas that is keen interest to the CFPB has to do with FCRA dispute resolution right now and vendor management. So that's a bit on the rulemaking side. We're all in pretty much of a stay tuned mode, but we wanted you to just understand what the time frame is surrounding rulemaking in the CFPB.
Rozanne,
now, in one of our notices, or go ahead, Mike.
Now, I just wanted, not to interrupt, before you moved on to the next bullet here, with regard to CFPB, question for you. My understanding is the first round of CFPB audits for arm companies began last March. They went through, since then, a number of agencies throughout the country. So far, to my knowledge, nobody has received any results yet from even the first round of audits. Is that correct? And do you have a sense of when they're going to get correspondence back, or have you heard any updates?
I do agree to my knowledge, and I feel as though it's I'm fairly well informed on this issue. Unless someone received a closing letter in the last couple of weeks, the agencies that have been examined by the CFPB have not had the files closed, that they've intentionally left them open, and that the final report has not been issued to collection agencies or debt buyers who have been examined by the CFPB. They are keeping those files open for a number of reasons, not the least of which is the fact that they have recently revamped their actual plan with regard to the final letter. And I'm going to talk about that in just a few moments. But it is true, the final reports have not been submitted to these agencies.
Very good. Thank you.
And that really is a nice segue into what do we know about what the CFPB has been up to in the past year, for example. And in one of the promotional items we released, we talked about the fact that the CFPB is attempting to be a very transparent organization. They recently released a document called Supervisory Highlights, the 3rd edition. You can all find that on the CFPB's website, which is cfpb.gov, and this publication really is just filled with information that helps us get a lot of clarity around the CFPB's concerns and activities. So, Shannon, just so you know, you are on the correct slide and the correct bullet, but I am expanding on the whole rulemaking process at this point, and we'll get into the vendor management in just a few moments. But I want to take some time to talk about what we know about the CFPB's activities. First of all, they are very, very interested in UDAP, the Unfair, Deceptive, or Abusive Acts and Practices section of Dodd-Frank. They have uncovered UDAP violations in the mortgage servicing industry. They are gaining traction in that area, understanding how UDAP may impact the collection industry as well. The CFPB teams have also reported that they are finding significant weaknesses in collection management systems, both in on the creditor side, but more pointedly on the collection side as well. In several instances, they have already directed collection agencies to implement immediate and broad sweeping changes to prevent violations of the law and to reduce risk to consumers. One actual direct piece of information I received from an organization that has had some exposure to the CFPB indicated that when they responded by explaining that, well, we really didn't realize that we had to have a full-blown compliance management system up and running already. I mean, you just announced it last October, for heaven's sakes. The CFPB believes that the industry, specifically the collection industry, has had time to build compliance management systems, and so they are really not considering I didn't know or I need more time as a viable excuse. They also are telling us that they are ready and able to levy fines against industry participants. They've engaged in 6 very significant CFPB enforcement actions this past year where they've levied some very, very hefty fines for the purpose of making consumers whole. And so we have one example that in J.P. Morgan Chase and Chase Bank, the CFPB has directed the Chase and Chase Bank to pay $2.1 million to consumers in terms of making them whole, and to return $309 million in refunds just simply related to credit card add-on products that were not clearly explained to consumers. They've also levied a $20 million fine against Chase in terms of civil penalties. So they are interested, without a doubt, in making consumers whole and getting the attention of supervised organization in terms of levying civil penalties. With regard to American Express, the CFPB has directed American Express to pay $59.5 million in refunds to 335 customers. Again, due to credit card add-on products that the CFPB felt were not clearly explained and communicated to the consumers. In that instance as well, American Express is going to have to pay $9.6 million in civil penalties directly to the CFPB. Now, an example of an organization that's a little bit near and dear to our hearts in terms of being part of the collection industry space, Cash America basically is an example of the first action the CFPB has taken against a payday lender, and Cash America will have to pay $14 million in refunds related to illegal collection activities as deemed by the CFPB, and $5 million in civil penalties for illegal collection activities. In particular, it had to do with the robo-signing of court documents in collection lawsuits. The CFPB is also very interested in activities surrounding Service Members Relief Act, and they have a heightened focus on protecting members of the military, particularly those on active duty. Mortgage Master and Washington Federal have to pay $450,000 in civil monetary penalties relating to simply the accuracy of data reported pursuant to the Home Mortgage Disclosure Act. And finally, Ally Bank and Ally Financial has to pay $80 million to more than 235,000 African American, Hispanic, Asian, and Pacific Islander borrowers for discriminatory lending practices under the Equal Credit Opportunity Act. They'll also have to pay $18 million in civil penalties. So to the extent people have believed that UDAP or the ECOA are just these kind of random tangential laws that we really don't need to focus on, I think the acts of the CFPB tell us that we do. So make no mistake, the CFPB will bring enforcement actions based on its supervisory and examination activities. It's also going to look for ways to pay consumers money to make them whole, and it will levy fines. In the collection space, I think as business people, you need to be very mindful of the risks you're running with regard to UDAP and the ECOA and collection practices generally, because if things are turned or couched as fines and penalties and refunds, if you will, it is likely, although it's not for me to make an opinion on this, but it's likely that your insurance may not cover those types of fines and penalties. So I just think that that's indicative of the aggressiveness of the CFPB in terms of its enforcement actions and also the impact that that can have on a particular company. We're talking some very, very big dollars. Another example of a hot issue is how payments are actually applied and how you communicate how payments are applied to consumers. Now, in one example, with the mortgage servicer, they offered a practice of we can help you reduce your overall payments because we'll apply your payments biweekly, and what the CFPB determined was that that actually was a deceptive practice, because what actually was happening is rather than applying payments consumers made biweekly, the company just basically saved the payment and made it as a 13-month, like a 13 additional monthly payment at the end of the year. And so whether or not we agree or disagree with the CFPB, they nonetheless felt that the practice of how the payments were applied was deceptive. Now, an example of where a self-audit actually paid off and self-reporting took place on the part of the company is also, I think, beneficial for people to understand, because the CFPB did earlier this year release a guidance document indicating that it expects people to conduct self-audits and to report any practices that they have identified as being in violation of the law. In this instance, it involved the practices of data furnishing, and through a self-audit, the data furnisher actually identified inaccuracies in the information it was reporting on consumer accounts. But because the data furnisher actually implemented new procedures to correct the mistakes in a timely manner, following an actual audit, the CFPB merely directed the data furnisher to strengthen its credit reporting practices to ensure that it reported accurate information to CRAs, and then to simply monitor and track exceptions in the future regarding inaccuracies, and to simply improve its training. So we do have a first-hand example of where self-reporting did ultimately benefit the data furnisher with regard to its credit reporting practices. And finally, I'd just like to mention that, again, that service members are near and dear to the CFPB's heart. And to quote, the CFPB has a particular interest in protecting consumers who are serving in the military. 2 services were actually cited for failing to conduct military scrubs and to apply the appropriate protections required under the Service Members Relief Act with regard to interest rates and borrowing, lending practices. So keep that in mind as you examine your compliance management systems and the breadth and scope of those systems within your organizations. On the administrative front, the CFPB also announced that effective January of 2014 that it would be making changes to the way that it reports back and issues supervisory letters following an examination. In particular, when they simply want you to make recommended changes to improve your practices, that's just going to be handled verbally, not in writing. They're going to remove the identities of the CFPB team members who have conducted the examination from the report, and they're going to create one single section in the report that includes all the items the CFPB expects the agency to address. Not just recommend, but expects them to address. So the report will no longer include required corrective actions per se. It's just going to create a single section of a list of material defects in the organization's compliance management system. With regard to legislative activity, we've seen a real uptick in legislative activity surrounding bills that impact the collection industry. About a week ago, federal legislation was introduced to allow an award of litigation costs to the collection agency defendants only if there is a finding by the court of bad faith on the part of the plaintiff. So this is rather shocking legislation from the industry perspective, because of the high standard you have to meet in order to obtain costs. You'd have to show bad faith on the part of the plaintiff and have a court interpret your evidence as such. But this was introduced in response to a case that came down earlier this year, referred to as the Marks decision, and basically the representative who introduced it, Representative Cartwright, he's very worried about the chilling effect this case may have on plaintiffs who are otherwise interested in bringing lawsuits against collection agencies and debt buyers for violating the law. So we'll have to pay close attention to that bill. Right now it does not have a significant number of co-sponsors. I think he may be making a statement more than us seeing this legislation passed into law, but one never knows in this environment of heightened consumer protection. In April, a bill was introduced to direct the IRS to enter into contracts with private collection agencies again to help recover, in particular, outstanding inactive tax receivables. So for those of you who have been around the block a few times and have been in the industry since the mid-90s, you are well aware that we have seen this whole opportunity, if you will, come to life and die a number of times. But once again, on the Senate side, we are seeing a bill to direct the IRS to enter into private contracts with private collection agencies. And finally, just one example of an initiative on the state law. I'd like to draw people's attention to the state of New York because a bill is moving through the General Assembly that would require collection agencies and debt buyers who operate within the state to be licensed and bonded. So those are some, a quick overview of rulemaking activity and some legislative activity that is taking place. So I just caution everyone to pay attention and to pay attention particularly to your trade associations as to the activity taking place on both fronts. Now with regard to vendor yes, Mike.
Rozanne, hi. Just to interrupt you here, the wording that you used on this bullet is excellent, and I think people might lose sight of the fact of how you define who a vendor is in the U.S. arm industry. Can you take a moment to talk about what you define, how you define vendors in this industry? Because I think it's very important that people understand why you use this wording on this particular bullet.
Well, I use this wording because I think it draws, people are very comfortable and they naturally understand vendor management, but the CFPB has actually, or actually Dodd-Frank and a number of resources have actually defined service provider for us. It's really any person that provides a material service to a covered person in connection with any consumer financial product or service. So it's any service provider that you may use to help you conduct your unique business. But there is an exception. Vendor, and the correct term is actually service provider, but vendor does not include a business that you work with who provides more of a ministerial service or a service that they would generally provide to any business, that they couldn't care less that you're in the collection space. So, for example, your florist, a pizza delivery service, the U.S. Postal Service, FedEx, your heating service, if you will. Those are not the types of service providers that help you perform your unique service in the collection space. They would provide those services to any business regardless of type. So that is why I use vendor simply because it is such a common term used in this industry, but the correct term is service provider. And might I add, for those of you who are on the phone who collect debt or are debt purchasers, you are actually service providers to your clients, but you in turn have service providers that provide services to help you conduct your business.
Thank you.
Mm-hmm. And when it comes to vendor management, it's a whole discipline around vendor management. The reason I wanted to say you are a vendor too is that there's an awful lot of focus of what you need to do to oversee and manage those service providers who help you perform your services. But keep in mind that you are a vendor too, and the reason I said, are you prepared? I would recommend that virtually everyone on the phone self-identify themselves as determine whether you are a service provider to another organization, such as the hospital you collect for, the credit card company, the bank, you name it, whoever your creditors are, and that you too need to be prepared. What that means is that there are steps you can take to better position yourself as a service provider who is well suited to provide services to supervised organizations. I have a vendor management ebook that I am very excited to share with anyone on the call who is interested in the 10 steps you can take to not only prepare yourself to be a well-positioned provider of services to your clients, but to also help you oversee and manage your service providers. Everything ranging from identifying who they are to the contract provisions you need to include in your service provider contract. Next bullet, Shannon. And I just lost. Am I the only one that lost visibility to the PowerPoint? Did you lose it, Mike, or not?
No, I could see it, and I'll read you the next bullet, managing disputes under the FCRA.
Yes, very quickly, I just want people to realize that
Rozanne, are you there?
Rozanne might have just gotten cut off for a moment because I got cut off for a moment, but I'm still here.
Yeah, and interestingly enough, it shows that there is that she's speaking, so she may not be aware that we can't hear her.
I'm sure she's not because we both got cut off at the same time, but I'm back, and you should be able to hear her now too. Why don't you send her a quick note, and I will as well.
For the participants, I apologize. We will get Rozanne back on the phone here as quickly as we can.
Well, while we're waiting for Rozanne to come back, I think we should all just take a moment and thank Donald Sterling. Now, you're probably asking yourself right now, why is he asking us to thank Donald Sterling? If you don't know, he's the current owner of the LA Clippers, and I emphasize current because that's always subject to change with what's going on in the NBA Association now. I just found out that an informal survey was conducted, and we learned that most consumers now hate this person more than any bill collectors. So we should be very happy about that, and feel free to spread this around to anybody else that you know. Informal survey. I'm happy to show you the results. Rozanne, are you back? I am sure these people don't want to hear another joke from me.
Yeah, just to bring everyone up to speed, it looks as though for some reason the system is now duplicating Rozanne. So it looks like she's still talking, but doesn't realize that she's in the system twice. So we'll see if we can fix that for her.
Has she been muted? I don't want to lose anybody. Please wait with us momentarily here while she gets back on the line.
Yeah, she has not. It looks like, just so that everyone knows, that she has deleted one of the sign-ins, so I'm sure that she's trying to join again.
If she's not back in a couple of seconds, what we could do, Shannon, is fast forward and come back to this section and let her finish up, but jump around a little bit. So we can improvise, but let's wait another 10 seconds or so and just see if she can come through.
Sure.
And in fact, while I'm talking on the next section, if we decide to go that way, you can hopefully call her offline and figure out what the issue is. Well, in the interest of everybody who's on this call, why don't we do that? Why don't you fast forward the slides here? I'll tell you when to stop. Stop there.
Okay.
But you know, she was going to talk about a specific market segment, which we'll reserve for the end. It's not the end of the world here. But Rozanne and I decided that we wanted to focus a topic on this webinar in particular here, as we're now in the middle part. I just lost the presentation also. Now that we're in the middle part of the year, 2014 here, that we thought we would talk about what we see trending within particular market segments. Most of the focus that you all hear in over recent months has to do with credit cards and the credit card sector. You might read in the news a lot about what's going on in that particular market segment, or at banks in particular. You might have just come back for some trade shows recently, and you hear about that particular market segment because that tends to have the most emphasis in today's market. We're going to switch gears and look at what's trending in some of the other consumer markets. Shannon, can you go to the next slide, please? Okay, great. I hope everybody sees a slide in front of them. Student loans expand while financial institutions contract. We all hear the buzz around the student loan market segment. You see it in the headlines. Students are taking out very, very sizable loans to educate themselves, and it's a concern in the marketplace. Folks are talking about it a great deal. Student loans have actually also been considered one of the U.S. ARM industry's growth market segments for about the past decade. If you look at this slide here, you'll see that the student loan debt market has actually grown, whereas other debt markets have decreased over the same time period. This slide is going to show you total outstandings in the student loan balances compared to other balances outstanding, such as those that exist within mortgages and credit cards and auto loans, for example. But you could see, looking back here to Q1 of 2003, so roughly 10 years ago, outstanding student loan balances have really gone up. They shot up dramatically and currently rank second behind mortgages, making up about 9% of the total debt market. And I think that's here to stay, folks. That's going to be like this for quite some time, whereas the other sizable segments of the market, most notoriously the credit cards, have decreased over the same period of time. Some facts that are playing into why student loans have really emerged as a focused asset class in this particular industry is, first of all, the sheer number. Total outstandings have surpassed $1 trillion last year. This increase is staggering. Last tallied about literally 312% over the last 10 years. In Q3 of 2003, the total was about $250 billion, and now it's in excess of $1 trillion just 10 years later. Another staggering point, the 90-day delinquency debt level for student loans is increasing faster than the total amount of student loans overall. In 2003, there were about almost 17 million college students in the United States. As of 2012, there was almost 21 million college students, which represents about a 22% increase over the past 10 years. This is projected to increase to about 22 million students by 2018. So the number is not anticipated to go down, but the growth rate is actually slowing down because of the cost level. Additionally, the average outstanding student loan amount has increased by about 70% since 2004. The Federal Reserve Bank of Kansas City estimates that the Q4 2012 average amount of debt was about $25,000, and the median was about $14,000. About 3.1% of the borrowers have over $100,000 in student loan debt, while about 0.5% have over $200,000 in debt. I mean, think about that for a second. If you came out of college now with $100,000 or $200,000, how many years are you just going to have to work exclusively to pay down student loans? Not to mention living on your own and the other expenses that you might incur, like maybe a gas bill or a food bill. Staggering numbers, absolutely staggering numbers, and I think that's one of the major reasons why attention has been placed in this particular segment of the market. Just so you know also, before we switch to, is Rozanne back?
I am, Mike. Can you hear me?
Okay. I think we can hear you fine. Welcome back, Rozanne. Before we switch back over to you, I just want to say that the marketplace estimates that right now, actually by about 2017, 87% of outstanding student loans will be public loans. That means those that are backed by the Department of Education. That's staggering. And the expectation is that's going to come down a little bit with direct lending reemerging, but it's still going to be predominantly provided by the U.S. Department of Education. Rozanne, we switched gears. I don't know that it's...
I know. It's okay. I heard everything. One thing I wanted to mention...
Go ahead.
I wanted to mention, Mike, is that on Friday, however, you know, when you think about this staggering student loan debt, it is mind-boggling. And there are a lot of people who either are in the student loan space or are moving into it for purposes of, you know, increasing their revenue. But on Friday, 7 members of Congress actually reached out to the Secretary of Education, and they advocated that we need to have new undue hardship guidelines so that they would allow certain people to be able to discharge federal student loans in bankruptcy. And this is really, really kind of a monumental event in a sense for those who collect student loans and for the whole student loan industry in general, because up until now that has been a big taboo to even talk about discharging student loan debt as the general practice in bankruptcy. So I really think people need to follow this particular legislation, because when you see mounting debt and it's touching so many consumers, particularly young consumers who are, in theory, graduating college and graduate school and medical school and law school, et cetera, and then to see a cry for the hardship exemption for bankruptcy, I mean, that's kind of a big deal.
Absolutely. Rozanne, why don't you, while you have the microphone, why don't you take a few minutes here and tell us what you're seeing on with regards to health care debt? Can we change the slide also, please, Shannon?
Absolutely. With regard to...
Nope. There you go.
With regard to healthcare debt, I just really would like people to, I really want to, I think, clear up some confusion in the marketplace. I mean, the percentages always change, but people generally agree that 70% of the collection agencies in the United States are collecting healthcare debt in one way, shape, or form, whether it's first party or third party. And for those people who are collecting healthcare debt, and they're collecting it on behalf of a nonprofit hospital, I just want people to be aware that the IRS and the U.S. Treasury at the end of December did make clear that the proposed rules surrounding 501R may be followed, and if you adhere to the proposed rules, that is going to be deemed a safe harbor for you. So the long and short of it is, if you're collecting debt for nonprofit hospitals, there are new rules surrounding the collection of medical debt, the timing of the collection activity, what you can do during, what kinds of collection activities you can engage in during the first 120 days after bill drop, and what you can do during the second 120 days. There's an equal amount of responsibilities being placed on nonprofit hospitals in terms of establishing financial assistance plans, communicating those plans to their patients, and restricting collection activities to basically calls and letters but non-legal activities during the first 120 days. So for those people who do collect for non-profit hospitals, the rules are out. Granted, they don't look like final rules, but it's an official position by the IRS and U.S. Treasury that effective the end of December, that was issued the end of December, I think it was December 30th, saying that please adhere to 501R proposed rules. I just wanted people to know that. Mike, do you want to talk a bit about what's going on in the telecom and cable markets?
Absolutely. By a show of hands, can you all show us how many of you are actually using your landline at home? Are you raising your hands? I don't see anybody raising their hands. Is that because we're on a webinar or because I can't see you raising your hands? But I'll assume nobody is raising their hands because I don't use my landline at home. I never use my landline at home. In fact, the only time we use it is when my mom calls, but she doesn't want to call on one of our cell phones. So we occasionally use it because we have to have it, usually for triple play with Comcast. But a lot of us don't even really need a landline right now. Rozanne, do you use your landline at home?
Very, very, very rarely. Quite honestly, the only reason I have a landline and people will probably roll their eyes is simply because if there was a fire, I don't want to have to look for my cell phone. But we are seriously thinking about abandoning it altogether.
So in the first half of this year, approximately, or first half of 2013, the most recent numbers, I think this number has actually gone up. About approximately 40% of American homes only had wireless telephones. I mean, think about that. They don't even have a landline anymore, and these aren't second homes. These are just American homes overall. I think this is why TCPA is really on the tips of everybody's tongue in this industry, and something that we continuously hear about and are concerned about with the growing population using predominantly and in many respects exclusively cell phones. Wireless subscriptions have risen from, listen to this, 55 million in 1997 to 326 million in December of 2012. That's tremendous. Consumers today are bundling more and more services. Analysts predict that in the year 2000, each user will require 10 simultaneous mobile connections because of the proliferation of use of electronic devices such as cell phones or iPads and tablets and integrated home and car services. It's tremendous. Telecom, long known as a lower a balance account, most of the folks who are servicing wireless and telecom typically complain that the account balances, while the volumes were high, the account balances tended to be very low. They have really increased in size and will continue to move in that direction as more is packed into this service. Cable and wireless, let's talk about cable for a second and wireless. Internet use continues to grow. In 1984, this is the first year that this data was recorded, easy for me to say. Internet use was at about 8% of U.S. households. By 2003, it was at about 62%, and by 2011, it was at 72%. That number today is probably over 80%. And Internet has increased because Internet has increased some 4% over the last couple of years, and it's expected to continue to increase as Americans and really internationally, but I think we're finding that we're catching up with our foreign friends in many respects. But as Americans become more technologically engaged, this is going to continue to increase. A couple more facts about the cable industry. The cable industry faces competition, really high levels right now, from satellite. You hear what's going on with AT&T bidding up the price right now for DirecTV. That's today's news. and online service providers like Hulu and Netflix, a big one. I know I watch Netflix. I download a number of shows that I've missed over the years to try and catch up on things, and Netflix is very popular among the next generation, people coming up as well. It's really reasonable to expect decreases in subscriptions in the cable world in the near future. So those of you who are out there servicing the cable providers, not only have we really peaked out, we're probably going to start to see decreases as a result of the increased competition. Satellite's been around for quite some time, but these online services are now out there producing their own shows. They've really become a threat to cable service providers. And I think that's going to continue. Rates are coming down compared to cable services, and they're certainly increasing with streaming populations out there and the affordability of streaming and broadband. We should pay particular attention to that. I think that the opportunity, though, for accounts receivable management firms in the online sector, specifically in the areas I just described, on the contingency side is really non-existent, since subscribers, they pay for these services through their credit cards, they pay for them up front. It's not something that's going to afford itself an opportunity for accounts receivable management firms. However, the real opportunity for these companies is on the first-party side, and that remains high because companies pay a lot to get these customers, and they want to work hard to retain the customers and remind them that their payment of bills is coming due, but it's more of a contact service and a customer care service than a collection services, and the agencies who are providing these front-end and customer care support services are currently and will continue to compete with some of the largest contact management firms out there, these multi-billion-dollar firms that can charge a lot less and really still continue to generate profits. Let's move on to the next slide here. Consumer deleveraging is what you should see in front of you right now. The total amount of debt borrowed by U.S. households significantly decreased over the past 5 years. So if you follow the line, the red line up, you could see that at around 2000, roughly 2007, no surprise, the start of the mortgage crisis, for about a 5-year period going out to about 2012, 2013, about that 5-year band, it actually decreased. However, we feel strongly that this round of deleveraging, the efforts that have been made by American consumers, is almost coming to an end. And we're anticipating a rebound that will have a profound effect on liquidation results. The availability of credit is actually increasing. Consumers are out, they're spending more, they're more confident. And we expect that there's actually going to be a pretty significant impact on U.S. accounts receivable management firms over the next 12 to 24 months. Prior to the mortgage crisis, again, starting around 2007, as we all painstakingly remember very well, consumers commonly used home equity to pay down their debt. That's often referred to by collection folks as the good old days. Increasing housing prices in today's market is actually enabling some consumers and homeowners to refinance and pay down their debt, a trend that we hope to continue to see in the housing market as the housing market continues to move in the right direction. Looking forward and over the next 5 years, the per capita disposable income is predicted to increase about 13% to over $37,000 per year per consumer. This supports consumers' ability to pay back their debts and perhaps even have more available to pay down severely delinquent loans that in the past couldn't be recovered. Hopefully we'll all see indications of that sooner rather than later, but certainly over the next 5 years. Rozanne, is there anything that you want to add before we move on to the next topic, which is M&A and M&A activities?
No, Mike, I think we're fine. Go ahead.
Okay. Well, in the interest of time, let's move forward here. Merger and acquisition movements. As recent as today, we saw a headline in the marketplace that was very much eye-grabbing. For those of you who have not seen today's news in the accounts receivable management industry, you'll quickly learn, if you follow mergers and acquisitions like we do, you probably already know about this. ACT, Account Control Technologies, based in California, announced that they're acquiring Convergent Resources. Convergent Resources, I believe, is headquartered in Atlanta. It's one of the firms that we know real well as a consolidator of collection agencies over recent years. This is a substantial acquisition for ACT, most noted their involvement with the U.S. Department of Education as a contractor for the Department of Ed. This is a substantial increase in their holdings and also in the types of clients that they service. So this just broke literally today, so it's newsworthy and also very timely with the topic that we're covering, because I think what we're finding is, and very few would disagree with me, that the interest in mergers and acquisitions in the debt collection accounts receivable management industry is back on the radar screen. It's increasing. It's substantial. But I will tell you, it is vastly different. And we look back at some of the predictions that we made last year. We now see some of them playing out, and I just want to use them as a segue into some of the topics that I want to talk to you about with regards to merger and acquisition activity. The first, I'll just read this to you. Some ARM companies focused on the financial services and telecom sectors will make acquisitions as a part of their growth strategy to diversify their focus. That was a prediction that was made about a year ago. We started seeing some indications of that going into 2013. And today, absolutely, it's the case. There are some large players in financial services that have shown clear indication that diversification and growth through acquisition is a strong point of their interest currently. You see that with some large players. For example, URS, United Recovery Systems, last month announced that they're acquiring Array Services Group out of Minnesota. Array is predominantly situated in the U.S. healthcare market. They're very well-known, very well-established player in that particular space. And you should know that since Audax, a private equity firm based in Boston, acquired URS in December of 2008, I believe. Array is now their fourth add-on acquisition. 3 of them are totally outside of the bank card, credit card space, which is where URS is most well known. And the one that they added was Plaza in the bank card space. But if you look at ERS, the student loan player, and the last 2 acquisitions in the healthcare space, it's a clear indication that mergers and acquisitions with this particular business has been used as a way to diversify. And I don't think one business is an indicator for an entire marketplace. I could tell you others, very sizable, financially supported players. A good example is ERC, headquartered out of Florida, backed by RLJ. They made a recent acquisition this past year in the BPO space to diversify the service offerings that they provide to their clients. Not to mention the clients that they service. They picked up a great company there. And you look around, you see the interest out there among financial service companies, focused companies, and I talk to them regularly, and their interest is certainly in growth. And if they're doing it organically, they're trying to grow into related but different asset classes within financial services, perhaps auto or mortgage and those areas, or are looking to diversify and grow some other segments of their business that they may be in currently and looking to expand into, such as healthcare, utility, or non-bank card, credit card work. Let's move forward on the slide, please. One more bullet. One more. Next topic that's very hot, very active in mergers and acquisitions continues to be the large debt buyers who are expanding through acquisition, and the way they're growing and diversifying is in non-U.S. markets through substantial growth and substantial acquisition. So starting in 2013, we saw that Encore Capital, a leading debt buyer, publicly traded debt buyer, announced in May that they were entering into an agreement to purchase controlling interest of Cabot based in the UK. They have since purchased outright Cabot and actually grew their holdings in Europe through acquisition, and by acquiring Marlin Financial Services also in the UK. And that was a substantial deal of approximately $480 million US. And then they announced that they were acquiring the rest of Cabot that they didn't have. Most recently, just a few weeks ago, Encore announced that they're also acquiring a company by the name of Grove Capital Management, a company that purchases credit card portfolios, has a focus in the UK and the Spanish assets. Substantial growth, but it's not just limited to Encore. PRA, Portfolio Recovery Associates, announced back in February that they're going to be spending some $1.3 billion and buying debt buyer Active Capital, arguably one of the largest, certainly the largest debt buying acquisition that's been made, but one of the largest acquisitions ever made in the accounts receivable management industry in the U.S. Or anywhere for that matter in the world. Very substantial. We don't think this trend is going to slow down. Certainly the magnitude will, because frankly speaking, there just aren't as many sizable companies as compared to what's been gobbled up just over the last couple of months. But there's another trend too, and that is in the debt buying space, the smaller and the mid-size, these portfolios continue to be acquired, but you don't hear too much about them. But they do continue to be acquired by the larger buyers who have compliance on the wraps. They feel comfortable in buying these portfolios from established debt buyers, and I think that trend is absolutely going to continue in the marketplace into the foreseeable future as compliance is real front and center. Yes, ma'am.
Well, my question is for our audience. Let's say you're not one of the mega-sized debt buyer organizations, and yet you're very accustomed to servicing debt buyers. What opportunities or impediments, can you comment on that for people who may want to, I mean, obviously debt buyers need to have their debt serviced unless they collect it themselves, but will there be an opportunity for collection agencies in the U.S. to assist with that expansion abroad, or are they going to be looking towards agencies in, in those locations to service the debt?
Well, Rozanne, you probably know this better than all of us, and that is the regulators out there are making noises that the debt buyers who acquire these portfolios are going to need to have their own in-house service capabilities on a going forward basis. Now, whether that's exclusively or partially, maybe some part will be farmed out, maybe some part will be kept in-house. There are some debt buyers that have not focused on building out service platforms over the years, and I do think that there will be some interest in buying service providers to bring into their fold these service capabilities so they could demonstrate that they're not only purchasing, but purchasing and servicing. That being said, there are a lot of folks who have grown over the years by servicing the debt buyers. And frankly speaking, I scratch my head and I say, you know, I understand that the feasting was good, it was a good time, but certainly the indications over the last 4 or 5 years are that new loans were not being created. So outstanding balances actually decreased. The amount of debt purchasing on these original loans decreased substantially in recent years. So their placement volumes certainly have been impacted, and I think those that have positioned themselves to service the debt buyers those that have survived have attempted to diversify from that asset class. But that being said, I do know that there are a number of service providers out there that successfully service the debt buyers, and they're selective on the ones that they actually work with, because they want to make sure that, you know, the connections are good. But when they are, they're doing very, very well from some of the large debt buyers that they continue to service.
Okay. Good.
Thank you, Rozanne. Let's move on to the next bullet here in the interest of time. We're already past 3 o'clock. Collection law firms. This has been a hot topic. I know NARCA met just this past week. I put out a blog post, if you hadn't seen it, about that I strongly believed that consolidation wasn't taking place among collection law firms. And I spoke to why I didn't think that this was an industry that would lend itself to a consolidation like we saw with private equity in the U.S. Collection industry. Just to speak to that for a moment, that I did not at all imply, nor that I intend to imply, that deals would not get done among collection law firms. We're seeing it now. There was a recent example. The law firm of Fine, Such, Kahn, and Shepard merged with Leviton and Freeland. Recent merger within the same state they service. And we think that this is a trend, not an exclusive event. And it's really, they're coming together, they're joining forces, they're cutting costs, they're expanding operations to service a broader base of clients within and also outside of their state. But let's not confuse the two. This is not a consolidation. Absolutely not a consolidation. This is an acquisition. This is a merger. This is certainly a trend, but it's not a consolidation of an industry like we saw between, was it 1995 and 2005, when 9 of the 10 largest U.S. debt collection agencies went through a transaction. 10 years. Think about that. The exception was GC Services. Everybody else went through a transaction in the top 10 ball players. I think that's indication of a consolidation. Maybe I'm wrong. Maybe we'll wait and see how this kind of plays out. But I do think we're going to see a substantial amount of activity among collection law firms joining forces. Let's move to the next bullet. Vendors are also making some moves. Now, when I say vendors here, what I am referring to is a little bit more narrow than what Rozanne referred to earlier. If you remember my question about her bullet when she was talking about the regulators. For me, vendors are those that provide a product and or a service to the end users of either a collection agency or a debt buyer or a credit grantor themselves. A lot of service providers are classified as vendors, but not for this particular comment. For this, what I'm focused on are the technology vendors and those that you typically see exhibiting at conferences like NARCA and or conferences like ACA in July, which I think is in Chicago this year, these vendors are starting to make some moves really in an attempt to keep up. And I think we're going to see more of these kinds of moves. LexisNexis acquired TraceMart out in the UK to expand their consumer data in the European markets. LiveVox just recently, about a month and a half ago, announced that they're taking an investment, substantial investment by Golden Gate Capital to increase their operations and continue to expand the needs of their clients. And I think you're going to see other vendors make moves, such as what you're seeing with these companies on the expansion side, as well as on the flip side, those that might look to get out for whatever reason. Maybe the getting out is good and they can maximize value, or maybe they just don't want to keep up and continue to invest in the trends that are necessary to expand their operations. One more bullet. Let me find my notes on this one. This is a big deal. Last June, Parallon acquired the Outsource Group. You might have heard about that deal. You might have just kind of brushed it off as another sizable deal. Outsource Group was certainly recognized as a large player in the healthcare services and accounts receivable management, as well as revenue cycle management for healthcare providers. But if you don't know this already, Parallon is a large business. It was a business that was launched by HCA to service their particular needs, and they've substantially expanded their business service capabilities, and they're going to continue to do so. And I think this should be earmarked really as a major disruptor in the ARM industry. As Rozanne said earlier, and just to repeat a comment that she made that I heard, that 70% of the ARM companies in the United States in one way, shape, or form service healthcare providers. It may be exclusively, it may be partially, but that's a big number. And if you think about that number, and you think about what just happened here, you might say, well, all right, now they're equipped and they're going to service the healthcare needs, the business or back office needs of their conglomerate of HCA hospitals and facilities. And that's absolutely true. So if you're servicing HCA clients, if you haven't already seen this disruption, you're certainly going to see some sense of this going forward, as the clients that you've been servicing for quite some time maybe move some portion, if not their entire business, to this vendor that's an in-house vendor. However, I can tell you that they're also bidding and winning non-HCA contracts. And I think that's where we're going to see the most disruption in the marketplace. And by the way, folks, this is not limited to Parallon. This is also taking place, we see it with Tenant's business service capability, which is Conifer, who's making similar moves. And I think overall, there's a lot of activities. I think we'll end on this one because this is just a substantial area. And yes, it's one transaction. I think it's significant. But I think we're going to see some moves that will be substantial and impactful over the next couple of years in this particular market segment. Let's move on to the next slide. Rozanne?
For reasons I'll never be able to explain, I was obviously lost audio earlier, and I apologize for that. I could hear everything you said, and one thing I know I did not finish explaining was this issue and focus of the CFPB on credit reporting. And what I just simply wanted to mention is a couple of things. For those people who are data furnishers, let me say it this way, you cannot choose to not be a data furnisher whenever you so please. let me say it this way. When you choose to enjoy the benefits of being a data furnisher, so too are you assuming the responsibilities on those accounts. And
Rozanne, we may have lost you again. Are you on mute?
I'm here. Can you hear me?
I can hear you.
Okay.
Mike, is there any other slide that we want to pop back to or have you cover while we're waiting on Rozanne?
Sure. Just bring down the rest of the bullets here. Okay. I know Rozanne wants to talk about voice drop technology, looking under the hood. I'm going to reserve that and skip around a little bit here. Compliance officers. It's amazing how hot compliance officers, this particular position. Those of you who are compliance officers, brush up your resumes. Just know that there's a lot of interest in you, and no, I'm not suggesting you should move on. You should stay where you are right now. I'm sure you're very happily engaged with your employer and your current organization. But the fact is, a lot of folks, because of the changes that are happening right now within the CFPB and on the regulatory front, where we see that compliance really trumps everything, including performance, a lot of folks are not only trying to, but in many instances required to have a head of compliance within their own organizations. And a lot of these are kind of exclusive positions now. They're not internal positions where folks may wear 2, 3, 4 hats and check the box of compliance officer. This is becoming really a front and center position. And I'll tell you, it's interesting. Rozanne is on this call. She's with Ontario Systems, as you know, and maybe some will view this as a shameless plug, but it wasn't intentional. There are firms out there and service firms like Ontario Systems that actually can work with you on the outsourced front. So if you realize that you have a problem and you have a real need, I believe, and I wish Rozanne was back on, hope she's back.
I'm here. I'm here.
Okay, so you can comment on this. I believe that the CFPB actually approves the outsourcing of compliance to third-party professionals. So glad you're back, Rozanne. Can you talk a little bit about that and then backtrack to the voice drop technology and also the topic where you got
what we are what we are finding is that that people are struggling to identify the most appropriate way to handle their compliance challenges, and the CFPB in its manual makes it very, very clear that organizations can retain third parties to assist with their compliance management system. No one can outsource responsibility or accountability for compliance with consumer financial laws, but you can outsource functions. So just as we saw people shockingly outsource HR and accounting functions many years ago, we are on the cutting edge of being able to outsource compliance functions so that you can choose to use a third party to help you implement compliance programs appropriate for the size and scale and complexity of your organization. So we're very, very excited about that opportunity, not only for selfish reasons, but quite honestly because this means that the industry can scale, and not everyone needs to approach compliance in the very same manner. You can tailor it to meet the size of your organization. With regard to the voice drop technology, the only reason I mentioned it is neither myself nor Ontario Systems has there's no connection to this technology. It's just something that I receive so many questions about, and it has to do with the marketplace responding to a TCPA challenge. I mean, I'm not going to be breaking any news story by saying that the TCPA creates risk for the collection industry. You all know that. What is interesting to me, though, is that the market is trying to respond with solutions. We've seen that through manual dialing technology that has surfaced in the past 7 months, and we're also seeing it through this technology called voice drop. Now, you know that the TCPA prohibits the placing of a call to a consumer's wireless number using an auto dialer or a pre-recorded message without the consumer's consent. So this technology seeks to introduce to the ARM industry a solution where you're not technically placing a call in the eyes of these companies. You are literally dropping, outside of the calling technology, you are dropping a message into a voicemail box, if you will, that really kind of usurps or goes around the technical requirement to place a call. I am not giving legal advice or business advice on this particular issue, but I find it particularly intriguing. I think that it is something that companies who are interested in really looking at their TCPA risk and maybe looking at alternatives, they may want to consider with their legal counsel analyzing what we're euphemistically referring to as voice drop technology. Basically, the phone never rings and the consumer has to call into the voicemail box. Yes, it's true that the consumer does use minutes or time to access that box, but it's a really interesting open question. So I'll say nothing more about it, but I just think I find it particularly intriguing. And what's one thing you can say, and Mike, I'm sure you'll agree about the collection industry, if nothing else, we are resilient. So with that, my only comment about the compliance officers too, I heard you commenting, Mike, about don't everybody, you know, leave your position or what have you. But I do want business owners to know that the industry as a whole is kind of upping their game when it comes to compliance, and it's because compliance needs to be front and center in your organization. I'll be the first to recognize that you are there to run a business, but on the other hand, you are now running a business in just a ever more highly regulated environment, and your chief compliance officer, your compliance officer, or your outsourcing partner really needs to take center stage in your organization. Other comments,
Rozanne,
Mike?
was there anything, yeah, I know we have a question, but let's finish this slide up first. Was there anything that you got cut off earlier that you just wanted to mention as it relates to CFPB or where you were earlier? Any last comments there, or should we just...
Well, the only thing I'm trying to communicate to people is that once you decide to be a data furnisher, you can't just walk away from it. So when you receive a dispute, either directly from a consumer or indirectly through the e-Oscar system, what some consider to be a brilliant solution in the old days was, well, I know, we'll just delete the item. We'll just forget about it. We'll just walk away, delete it from the credit report, pretend it never happened. No, 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 no. The CFPB today is saying, you furnished the data, you're in there through the dispute process. You shall investigate. You shall consider all the documentation available to you and or your client or submitted by the consumer or the credit reporting agency to verify to investigate the dispute and to respond to the dispute in a very meaningful way. So really it's because of so many of the CFPB assessments I do, I'm kind of able to see from the inside out how some people are managing the cost of the investigation process in response to a dispute. And let me say this, it's not just simply deleting the item from the report. That's all I really wanted to communicate, Mike.
Okay. Okay, and I'm just going to make one closing comment here as it relates to the barrier to entry bullet that you see there as last, and that is, let me put it to you this way, increased regulation, I think will consolidate a lot of change and perhaps consolidation in the accounts receivable management industry. However, the intense regulatory environment that we're talking about during today's call, that you're seeing firsthand within your own operation, with your clients, go to a trade show, it's kind of somber, it's something that everybody is talking about, presenters are talking about, breakout sessions are talking about it. Heck, you could sit at a table over lunch and it's usually a hot topic about regulation and or compliance. But I think really what we're seeing right now is this environment, this regulatory enriched environment here is creating for the very first time a true barrier to entry in the U.S. accounts receivable management industry. For those of you who've been in this market for decades, you would know that it used to be if you had a telephone and an account, you could collect bills. And then over the years, the clients, especially the large banks, wanted to see some history. So they would establish themselves as saying that they're really not going to go out to a third-party vendor unless they had 3 years of experience servicing their type of account. But also we saw a number of market leaders, executives, former CEOs break off from existing operations, start a new operation, and all of a sudden they're back in business too because they're pedigree, right? They had a lot of experience, they had a lot of capability, and they had the battle wounds to kind of show for it, so they were getting some business. But today, right now, we're actually seeing, because of the costs involved in compliance and the increased need to stay ahead and continue to invest back into the business instead of pulling those proceeds out and putting them elsewhere or using them as return on investment. The cost of running these operations continues to increase, and really as a result, it's created a true barrier to entry in this marketplace, and those that are in the industry should be benefiting from that, because those who are investing back in and continue to increase their own capabilities in their own operations will be the true beneficiary of these barriers as they continue to be defined. The last thing that I'll say is I want to echo Rozanne's sentiment, which she just mentioned quickly just a moment ago about collectors being resilient. Those in this industry are truly a resilient bunch, and I believe very strongly entrepreneurial driven, inspired. They work hard. This is a hard industry, and those that are at the forefront really work hard to produce results. And I think what you're going to find is those that are strong-willed and forward-thinking are going to find ways to adapt and really even thrive in this marketplace and continue to respond to the changes that are out there. I know we're buttoned right up against the end. Rozanne, there was one question that Shannon wanted to answer. Can you just start with that?
I hope so. I hope so. I'm afraid to talk, to be honest with you. Anyway, I noticed there was a question about the Fair Medical Credit Reporting Act or whatever. I'm aware of a number of pieces of legislation that have been introduced over the past couple of years that have to do with things such as once a medical debt is paid in full or settled to the satisfaction of the hospital, that the item must be removed from the credit report within 45 days. If that is what that person is referring to, that has not been passed into law. But that phraseology used by the party who asked the question is also addressed in the Credit Reporting Act itself, in that there are certain requirements and restrictions on how you use credit reports and how you furnish data with regard to medical debt. I would encourage anyone in this our listening audience to feel free to reach out directly to me or to you, Mike. I believe our contact information is available. Yeah. But obviously for me, it's Rozanne, R-O-Z-A-N-N-E .Andersen with an E-N at OntarioSystems.com. And Mike, would you like to share your email address?
Yes. In fact, Shannon just posted it on the screen, so you could see it there in our presentations. Mine is simply Mike, M-I-K-E, at Kaulkin, Kaulkin.com. A couple of parting shots here. First of all, thank you very much for participating. Rozanne, thank you very much for your active participation in this webinar. I enjoy doing these with you and look forward to doing a couple more. Shannon and your team at Ontario Systems, in spite of the minor glitch that we have, a lot goes into putting these webinars on, and we appreciate all of the technical support that they're providing during this call and also in the weeks leading up to making this event happen. I do want to say, just so you know, when Rozanne and I talked at the beginning of the year, we planned on this being a 4-part series, and we're committed to doing that. So if you found this beneficial, please come back at the next one, which you'll hear about in the marketplace as to the exact dates and times, and participate. Maybe spread the word internally within your own organization or within your colleagues. Let them know that this is taking place. If you found it beneficial, maybe they should participate as well. We'll look forward to talking to you. If you submit any questions, we will make sure each and every one of them are handled personally so you get the attention that you deserve. Thank you very much.
And before you all hang up, just as a reminder, we will be sending out a link to this recording and look forward to seeing you on the next webinar. Thank you.